one of the things that kept coming up with the teams I met with yesterday was some of the details about the finances, how you manage your finances, how you manage your debt and your equity and those sorts of things. So I just wanted to make a real quick video so that I didn't have to keep repeating it for everybody, just to point out some of those nuances. One of the most obvious ones, and again, your numbers are going to be very unique to your company, okay? So this is just a sort of a generic company, so don't put any stock in the actual numbers themselves. But one of the key things is, are you going to have enough money next year to cover all of your expenses? And I mentioned this in the orientation, but it bears repeating. When you see this projected cash balance here, it's important to understand that that's just a projection. And it's a projection which is based on other forecasts and projections and assumptions that you've made, right? So it's entirely possible that even though you're projecting a positive cash balance, you could end up running out of money and getting the emergency loan and suffering all the consequences of that, okay? So what you need to be thinking about is, for one thing, how accurate do you think your forecasts are? Because this $53 million projected cash balance for this weird generic company, that's a function of how much revenue we bring in. Right? We're predicting almost $450 million worth of revenue. We may not get that much, right? This is based on a demand forecast, which is based on assumptions of industry average, price, quality, advertising, and those things. If we're wrong, then we may not get as much revenue as we expect, okay? So I really want you to think about your projected cash balance as a percentage of your revenue projection, and I want you to think carefully about two things. How accurate do you think your forecast is? Which at the beginning probably isn't all that accurate. And number two, how risk tolerant are you? Okay, and so those two things will sort of give you a sense for how much cushion or how much room for error do you want to leave yourself in your cash balance, okay, in order to avoid the emergency loans. Okay, so that's I've mentioned that in the orientation, but it does bear repeating because it's important, okay. Second thing, little detail with respect to the finance that I did not mention in the orientation, is the fact that you're taking over a company that's been in operation for a number of years, and up until now, you've been giving your shareholders a dividend. Okay, if you were to take that dividend away from them, they're not going to be happy, right? What shareholders want is they want steady or increasing dividends. So when you think about your finances, just like everything else, you need to be thinking about it with a long-term perspective, right? Not about how much dividend could you offer this year, but how does that fit into a longer-term dividend policy which will allow you to satisfy the shareholders in a way that, it gives them steady or increasing dividends, okay? And so now that doesn't mean you have to give any kind of a dividend, because you could very well make the argument that while you're in this transition phase, instead of giving that money back to the shareholders and letting them invest it themselves, maybe you need to hold on to that money and invest it internally in order to put the company in a position to achieve long-term success. You could absolutely make that argument. It would not be unreasonable, but I do want you to understand that the result of that, right, one of the consequences of that is probably going to be a short-term decline in your stock price, right? All else being equal, you take people's dividends away, they're not going to be as interested in your stock. They're not going to value the company as highly, okay? So keep that in mind. Something else about the dividends, and this goes to more of a sort of a deeper approach to understanding the financial structure of the company, right? So when you look at this projected cash balance, and I've said this to a few of the teams, really what that makes it look like is your money, you've got one big bucket, right? And you've got money flowing into the bucket from revenue and other things. You got money flowing out of the bucket to pay for your expenses and your investments. And this is what you think is going to be left in the bucket at the end of the year, right? I would love to have that bucket. And that's not wrong, because it is all the money that belongs to the company and by extension to the shareholders. But that's not necessarily the most effective way to think of it if you're trying to manage your finances in an effective way. Okay, so maybe a better way to look at it would be to say we have money in and out associated with operations, and we have money in and out associated with capital investments. Okay, now the reason that's important is because no one would ever, or no one should ever, do something like take out a loan. I'm going to borrow money and then use that money to pay a dividend. That is really, really poor financial management in a corporate setting. Okay, but that doesn't mean that you can't take out a loan at the same time that you're paying a dividend, right? And I say that because, if you decide to offer a dividend, you may end up with a projected cash balance which is negative, or at least less than what you think it ought to be. And so then you take out a loan, right? And you think, oh, I'm taking out a loan to pay a dividend. If you are, that's bad. Okay, if you are, you need to stop and rethink. But what you might actually be doing is keeping these two streams of inflows and outflows separate. And what I mean by that is, if you're paying a dividend, that should be profits from operations. Okay, so you look over here in your projected financial performance, and you project that you're going to generate $2.28 worth of profit per share, earnings per share, next year. Okay, so for every share outstanding, you're going to have $2.28 worth of profit. You might say, all right, I'm going to pay $1 of that back to you as a dividend to the shareholders because that's your money, right? And we're going to hold on to $1.28 of it, or however much of it is left, because the real EPS is not going to be exactly this. We're going to give you back $1. We're going to hold on to the rest to invest internally. Okay, and at the same time, maybe you're making some big investment in facilities or equipment or upgrades, right? These are capital investments. Okay, so at the same time you're taking these proceeds of your operations and paying some of them back as a dividend to the shareholders, maybe you're making investments in capital expenses and you're letting the bank pay for those, right? You're letting the debt cover those capital investments. All right, and that's perfectly fine. It's not borrowing money to pay a dividend. It's borrowing money to invest in capital, and it's paying a dividend out of operational profits. Okay, two distinct streams that will allow you to manage your finances more effectively, right? And you think, why would you borrow money to invest in a plant upgrade? Well, that's a question of leverage, right? So what we're interested in is earnings per share and return on equity. Given the amount of money that the investors have trusted us with, how much are we giving back to them, right? How much profit are we generating for each dollar of investment, of equity? Okay. Now come back to these upgrades, and in this hypothetical example, let's just pick this one right here. Okay. So this upgrade in Asia, it's going to cost us a $10 million investment. That's a capital investment, but we think it's going to return us a $3.5 million savings per year. That's a 35% return on investment. Okay, now if I were to hold on to profits, if I were to withhold the money that I might otherwise send out as a dividend, I'm going to hold on to it instead, and I'm going to invest it in this upgrade. Well, then I'm generating a 35% return on that piece of my investment for the shareholders, and that's a pretty good thing, right? But the alternative would be to say, instead of letting the shareholders fund this investment and get a 35% return, I'm going to let the bank fund that investment, right? So I'm going to borrow money, let's say at 8%, and I'm going to invest that in something that generates 35% return. My shareholders get the spread. They get that 27% difference without having to give me another dime. Okay, so that goes directly to their earnings per share and return on equity without me increasing the amount of equity that they've got tied up in the company. Okay, so in that case, it might make a whole lot of sense to use debt in order to fund those capital expansions, even if at the same time you're paying dividends out of your operational profits. Okay, the other thing I want to point out about debt, like I mentioned in the In Defense of Debt video, clearly debt can be mismanaged. You can have too much. It can become problematic. But you can also have too little, right? You could be missing out on an opportunity to maximize shareholder returns because you're not taking proper advantage of debt and leverage. Okay, so what I'm going to point you to are these ratios down here, just to give you some sense of where you stand with respect to your debt position. Okay, your interest coverage ratio, your debt to asset ratio, your risk of default. All of these indicators here are telling me that this particular company is under leveraged. They have enough capacity. They have enough revenue, profitability, income to be able to handle more debt. And if they were to take on more debt, then they could boost the returns that they generate to their shareholders through leverage, right? Through the example, just like the hot dog cart that I gave you in the debt video. Okay, and so this is a great thing to look at when you're managing your. I'll stay on the subject for the time being, right? Let's say you do find yourself in this position where you feel like you are under leveraged, okay, where you could actually boost your EPS and your ROE by taking advantage of more debt, more loans from the bank, okay. It is not at all uncommon, and companies do this sort of thing in the real world all the time. Let's say I'm happy with the amount of capital in the company. I don't need to make any more investments than I can currently cover, right? I don't need any new facilities or equipment or capacity or any of that kind of stuff, right? So I want to keep the amount of capital invested in the company constant. I just want to rearrange where it's coming from. I want to gain leverage by taking advantage of more bank money. In that case, what companies do is they will borrow money from the bank, and they will take the money they borrow and they will use it to repurchase stock from the shareholders. Okay, there's absolutely nothing wrong with that. All you're doing is saying we need a certain amount of money in this company for property, plant, and equipment, right? We just want to rely a little bit less on the shareholders, and we want to rely a little bit more on the bank. That's going to give us a higher leverage ratio, and if we're doing it right and we're managing effectively, that's going to give our shareholders a bigger return on their investment. Okay, and that's really what we're trying to achieve over the long run. And I should say the opposite is true too. If a company finds itself over leveraged with debt and it becomes a problem, it becomes difficult to manage, or the interest costs start to outweigh the benefits of the leverage, you might do the exact opposite. You might issue stock, right? Raise equity in order to retire debt. And again, you might be keeping the total amount of equity the same. You're just changing the mix, okay, in order to maximize your ability to generate these returns for the shareholders. Okay, so and again, if any of you want me to take a look at your specific situation with your specific company, I am absolutely thrilled to do that. So just let me know, and I can log in just like we've been doing with these meetings, and I can take a look. Okay, so in the meantime, if you have any questions, please let me know.